In this video I will be explaining the 10 best trading strategies in the simplest and easiest way that even a 7-year-old child can understand. Now, tribe soldiers, let's dive straight into it. 1. Support and resistance. Support and resistance is the father of all strategies and also the most traded strategy in trading. You will always find a piece of it in every trading strategy. A support is a level on the chart where buyers are very active and where buying activities are most likely to happen, while a resistance is an area where the sellers are more active and where selling activities are more likely to happen in the future. In order to spot a support area, you identify two lows where price have respected and you draw a horizontal line on it. And to spot a resistance area, you look for two highs on the chart where price have fell from and made good impacts on the chart, and then draw a horizontal line on them. The goal is that anytime that price returns to one of these lines, you look for an opportunity to enter the market. And those opportunities can come in form of a strong candlestick entry signal or a strong candlestick pattern, and sometimes when you are analyzing a bigger support and resistance area, you can trade them by identifying strong entry opportunities using reversal chart patterns such as the double top and double bottom to make stronger entries. The support and resistance works great in ranging and trending markets, but sometimes in the trending markets, you will find out that the buyers often breaks the resistance zone aggressively in an uptrend, and the sellers can also break the support zone aggressively in a downtrend to continue the trend. And that's where the second strategy comes into play, the pullback strategy. The pullback strategy is an extension of the support and resistance strategy, but the difference here is that the pullback strategy can only be used in trending markets in order to lock in on trend continuations. In this strategy, the resistance can be converted and used as a support, and the support can be converted and used as a resistance, all depending on the current trend. This conversion happens when there is an aggressive breakout at the support or resistance zone. For example, when we are in an uptrend, we expect the market to keep rising up. And for this to happen, there have to be a continuous breakout to the upside. In this way, the market will break the resistance zone aggressively to the upside. And then the pullback occurs when price retraces back to the former resistance line, which has now become a support. And from there, the market will continue rising to the upside. The reverse happens in a downtrend. Here there is a need for a continuous breakout to the downside to keep the trend flowing. And for that to happen, the sellers will break a support line aggressively and then convert it to a resistance. And when the market retraces back to the new resistance line, the price will start falling from there in continuation of the trend. This is a great way of rocking the trend, but wait until you see the next strategy, which is popularly known as the trendline strategy. The trendline is like the mother of all trading strategies. You can also find it playing a huge role in other trading strategies. It is a very powerful trading strategy that even if you focus only on the trendline strategy and master it, you can be able to beat a lot of traders hands down. The trendline is drawn by connecting two progressive or trending price movements. The lines are drawn on the wicks or inside the wicks of the connecting candles. At the lows or highs, when drawing the trend lines, you should take your hands away from the main body of the candle in order to avoid trend noises in the future, as the strength and accuracy of the trend movement lies more on a trend line that is drawn on the wicks or inside the wicks of the connecting candles. We look for a trading opportunity when price retraces back to the trend line, and at the point of touching the trend line, we expect a strong candlestick entry signal to appear on the trend line to signal us to take the trade, and from there we enter the market, applying a good risk management. The trend line can also be combined with the pullback strategy to create a confluence and give more backing to the price movements in order to trade the trend effectively. I will be leaving a link to the full course on each of these trading strategies in the description box below, so you can master them completely. But before that, let's move on to the next trading strategy, Normally, the trend lines are drawn manually by the trader, but with this indicator strategy, we can get it drawn automatically. We call this the moving average strategy. The moving average is a trend moving indicator that keeps us ahead of the market movement and help us to get in on trend continuations, and most times it can also drop hints to identify trend reversals. The moving average can be traded as one moving average line, or with a combination of two moving average lines or more, but basically, it is best to trade it with one moving average line and two moving average lines at most. There are two ways of trading the moving average. The first strategy is to get in on a trade after price crosses over the moving average line, which signals a trend reversal. And the second strategy is to enter the market when price retraces to the moving average line, signaling a trend continuation. You know the market is in a downtrend when price is moving below the moving average line, and you can identify that you are in an uptrend when price is moving above the moving average line. The moving average is one of the most used indicator in trading, as it helps to give traders an edge in trending markets. But there is another indicator strategy that helps you to identify the strength of the market in both ranging and trending markets, and we call it the RSI indicator strategy. RSI is an abbreviation which means Relative Strength Index. It is used to identify strong price movements on the chart. Through its qualities, it helps to signal overbought and oversold regions. When the RSI line crosses the overbought region, it is believed that price will start falling and traders will start looking for selling opportunities, and when it touches the oversold region, it is believed that price will start rising. Then the traders will start looking for buying opportunities. The best way to trade the RSI in a trending market is to only focus on the signals from the oversold region when the market is in an uptrend, and to only focus on the signals generated at the overbought region when the market is in a downtrend. This way you reduce your chances of being stopped out of a trade by 80%. A more advanced way of trading the RSI indicator is by trading the RSI divergence, and that I have taught in my previous video on RSI indicator trading strategy. The next strategy is called the supply and demand strategy. A supply or a demand level are those areas on the chart where sellers or buyers have made significant price movements on the chart. A supply zone is an area where sellers are very active, while a demand zone is an area where buyers are very active. Many people compare them with the support and resistance. Meanwhile, they are clearly different from each other. The support and resistance strategy needs to lows or highs to confirm a good zone, while the supply and demand strategy only needs one significant movement to become a great zone. When you find a good supply or demand zone, you draw out a box on the last candle of the movement, then you wait for price to return to it. And when it does, you trade it using a good candlestick entry candle. And next, we have another strategy, which is a bit similar to the supply and demand strategy. We can say it's the more advanced strategy of the supply and demand. And this strategy is called the order block strategy, or smart money concepts. The order block is harnessed by finding supply and demand zones at very strategic points in the market with the help of certain candlesticks, or at the signal of certain candlestick behaviors. There are two main types of order blocks. We have the base order block and the flip order blocks. A base order block is found at the beginning of price movements, before price returns to it, and the flip order block is found at flip zones, which is at the point of a breakout, or after a breakout, at a support or resistance zone. There are a lot of strategies associated with order blocks and smart money concepts, and it's like a whole new world on its own. But the two most important feature is the order block and a break of structure. The rule is that price must break the last structure of the market before returning to the order block. And after that, when the market returns, you look for a good entry candlesticks to enter the trade with. Order blocks are very simple, but most traders complicate them a lot. I have a complete trading course on order blocks and smart money concepts, and you will find them in the description box below. The next trading strategy is the chart pattern strategy. This is actually a combination of different trading strategies made up of different structures in the market. It is made up of reversal patterns, continuation patterns, and neutral patterns, meaning that some of them appear to signal a reversal of the current trend to a new trend. Others appear on the chart to signal a continuation of the current trend, and some can appear to either signal a reversal or a continuation of the trend, depending on the breakout point. Some of these chart patterns includes the head and shoulders, the double top and double bottom patterns, the triangular pattern, and a lot more. They are all traded best according to a break and retest strategy, which will lead us into the next strategy, called the breakout strategy. The breakout strategy contains one of the typical way of trading chart patterns. You wait for a breakout and then allow price to retest the connecting lines, and from there you take your trade. But the difference is that breakout traders concentrate more on the rectangle chart pattern and the triangular chart patterns. Many breakout traders are not patient enough to wait for the retest of price on the connecting line, so they enter a trade immediately there is a breakout of the line, and they mostly do this by placing limit orders at the breakout point, which is not a good way of trading them, since price will often go back into the lines after breaking out, thereby creating more losses for the trader. It's always better to stick to the break and retest strategy when trading with the breakout strategy, so that you can win more as you use them. The next strategy is the candlesticks pattern strategy. This strategy cannot be used on its own. It is used with other trading strategies, such as the support and resistance strategy, the trendline strategy, the supply and demand strategy, and more. Some traders focus on only one of these candlesticks pattern and master it for all of their entries, while some combine two or more candlesticks pattern to seek better entries. The candlestick pattern can come as a single entry candlestick or as a pattern made up of two or more candlesticks. The single entry candlesticks includes candles like the pin bar, the momentum candlestick, the doji candlestick, and more, while the candlestick patterns include candlestick formations such as the morning star, the evening star, the engulfing candlestick pattern, and more. Whichever one you choose to trade, you must understand that they cannot be traded alone, as there are many candlesticks that appear on the chart. They can only be traded at the strategic points in the market, such as the support and resistance zones, the trendline zones, and more. Candlestick or candlesticks patterns are used to complete a trading strategy. All these trading strategies that I have talked about in this video are very effective and can work wonders in the market if you take your time to master them and trade them with best entry candlestick or candlestick patterns, and also follow the correct risk management plan that are associated with each of these trading strategies. Their risk management differs, and you cannot trade all of them on one time frame in the market. For some of them, you will have to stick to one particular time frame, and for others, you will have to do a top-down analysis before trading them. But nevertheless, I have dropped the full course to each of these trading strategies in the description box below. And to move faster in your trading journey to success, I recommend you begin with support and resistance strategy, as it is the main block of all other strategies. And if you want to become my student to learn personally from me, the link to contact me is in the description box below. We are the Trading Tribe, and it's a wrap for this video. See you in the next one.